In today's video, we will go over various methods of investing in real estate, regardless of your income level. Many people view real estate investing as a high capital endeavor, but there are now other options available for the average person to include real estate in their investment portfolio. Institutional investors typically allocate 30% of their portfolio to private market deals, with real estate being a component of that. This provides stability and long-term performance. However, not everyone has access to these types of investments. So, we will explore ways for you to gain similar exposure in your own portfolio. Be sure to watch the entire video. Let's begin by discussing the first option for real estate investing, which is acquiring a single-family home to rent out. This is a common form of real estate investment. If you're interested in buying a rental property, there are some things to keep in mind before making the purchase. It's essential to conduct thorough research and due diligence to understand the local real estate market. This includes determining the type of property that would be most in demand as a rental, such as student rentals, young professionals, or families, and the availability of good school districts. Additionally, you should consider the population growth and whether the area is in the path of progress with job opportunities and a growing population. The cost of buying and maintaining the property is also an essential factor to consider, such as the purchase price, closing costs, property taxes, insurance, and any necessary renovations or repairs. If you are seeking a simple method for evaluating a potential real estate investment, some people use the 1% rule. This rule uses the price of the investment property and compares it to the gross income it will generate. To use this rule, the monthly rental income should be at least 1% of the total purchase price. For instance, a property that costs $100,000 should have a monthly rent of at least $1,000. Additionally, it's important to factor in ongoing expenses such as management fees and maintenance costs. It's crucial to consider the potential return on investment, which is the ultimate goal of investing. To do this, examine the projected rental income and compare it to the cost of owning the property, which will give you an idea of how long it will take to recoup the initial investment and start making a profit. When it comes to evaluating the potential profitability of a rental property, it's possible to use the metric of cash-on-cash return. This is calculated by dividing the annual cash flow by the cash outlay, or the amount of money you have invested in the property. It is then expressed as a percentage. Additionally, it's crucial to consider the financing options available to you when purchasing a rental property. You may need to take out a mortgage or loan, so it's important to research different lenders and find one that offers favorable terms. Furthermore, it's a good idea to seek the advice of a real estate professional or attorney to fully understand the legal and financial aspects of buying a rental property. Ultimately, buying a single-family home to rent out can be a great investment, but it's essential to do your due diligence and weigh all the factors involved. Before continuing, if you are finding this content useful, consider taking a moment to hit the subscribe button, like the video, and turn on your notifications to stay updated on our latest videos. The second strategy to consider when investing in real estate is house hacking. House hacking involves purchasing a property with multiple units, such as a duplex or multifamily home, and renting out the additional units to offset the cost of your mortgage. The idea is to potentially generate a profit, and it can be a great way to jumpstart your wealth. Another option for house hacking is to have roommates in a single-family home or a large condo, where you can rent out rooms and offset your living expenses. House hacking can be a smart financial move for those just starting out in real estate investing and looking for ways to maximize their investment. So we have different options for approaching house hacking. Another option is to convert a finished basement or attic into a separate living space and renting out the rest of the house. This approach can significantly reduce living costs, generate a profit, and help you build equity in a property, making it a great long-term investment for wealth generation. However, being a landlord comes with its own set of responsibilities, such as handling tenant issues, complying with local laws and regulations, and being aware of any tax implications. Additionally, it's important to be mindful of any potential financial and relationship issues that may arise if you decide to rent to friends or family. Ultimately, whether or not house hacking is the right choice for you depends on your own goals and circumstances. House flipping is another popular real estate investment strategy. It involves purchasing a property, renovating it, and then selling it for a profit. On the surface, it may seem like a simple and straightforward way to make money in the real estate market, but it's important to keep in mind that the process can be risky, and there are many factors to consider before diving in. Due diligence and careful research is crucial in order to avoid potential losses. It is also important to be aware of market trends and conditions, as well as the costs associated with renovating and selling a property. So when it comes to house flipping, there are a few key things to keep in mind. The first and most important factor is location and after-repair value. You want to look for properties in desirable neighborhoods that have the potential for significant profit margins once they are renovated. This means finding a balance between a property that is in a desirable location but also has the potential for significant profit margins after the renovation. The next thing to consider is the condition of the property. What is the condition of the property and how much money will it take to fix it up? Will it require major renovations or just some cosmetic updates? It's important to have a good understanding of the costs involved in the renovation process, including materials, labor, and any unexpected expenses that may come up. It's essential to budget appropriately and leave room for contingencies. When flipping a house, it's essential to have a clear understanding of your ideal customer or target market. Are you flipping the property for families, first-time home buyers, young professionals, or investors? Knowing who you plan to sell to will help guide your design and renovation decisions to appeal to your potential buyers. Additionally, researching current market conditions by looking at comparable properties in the area and understanding their selling prices will give you a better idea of what to expect when selling your renovated property and if the flip will be a profitable one. Real estate syndications and funds are another way for investors to invest in larger commercial properties that they may not have had access to otherwise. By pooling their money together, investors can purchase and manage these properties as a group. This can be especially beneficial for first-time buyers or those who are looking to invest in a property but may not have the financial means to do so individually. There are two main types of syndications: equity and debt. In equity syndications, investors contribute capital in exchange for ownership in the property, while in debt syndications, investors provide financing to the property in the form of a loan. Most syndications and sponsors opt for equity deals as it allows for more control and decision-making in the management of the property. Real estate syndications can provide a way for investors to earn passive income by pooling their money together to purchase and manage larger commercial properties. These investments can lead to quarterly payouts and the potential for large returns when the property is sold. As an investor, you may also receive a share of the rental income generated by the property, which is typically managed by a sponsor. This income is usually paid out on a quarterly basis. When considering investing in a real estate syndication, it is crucial to thoroughly evaluate the potential risks and returns. This includes researching the sponsor or the individual presenting the investment opportunity to ensure they have a track record of success and experience in the industry. Investing blindly or without proper research could lead to potential losses. When considering investing in real estate, it's important to steer clear of the flashy properties like high-end hotels or class of multifamily properties, like those found in South Beach or Miami. Instead, focus on less glamorous Class B communities that have good schools, employment opportunities, and population growth, but just need a little attention. For those who do not want to navigate the complexity of researching sponsors and vetting investment opportunities, these working-class communities can provide a way to have real estate exposure in their portfolio without the hassle. The fifth method of investing in real estate is through real estate investment trusts. REITs allow individuals to invest in real estate without actually owning the properties. Instead, they are publicly traded companies similar to stocks that own, manage, and finance real estate assets such as apartments, office buildings, shopping centers, warehouses, and more. A significant advantage of REITs is their potential for high returns and dividends. This is because they are required to distribute at least 90% of their taxable income to shareholders as dividends. Investing in real estate investment trusts can offer a reliable source of income. An example of a REIT is Vanguard's Diversified Rate Index Fund or ETF. This investment provides exposure to different real estate sectors and locations, offering diversification in case one area experiences economic turbulence. There are various types of REITs, including equity which own and manage properties, and mortgage REITs, which provide loans to real estate investors and collect interest on those loans. The options for REITs are numerous. However, for the purpose of this video, a comprehensive discussion is beyond the scope. Investing in REITs can be a good choice for those who want to be a part of the real estate market without the need for time, experience, or a large amount of funds. However, it is crucial to remember that REITs, like any other investment, come with their own set of dangers. This may include a decrease in the property's worth, especially during economic changes. Usually, when people lose their jobs, companies have to make layoffs, or tenants are unable to pay rent. REITs are negatively affected and may result in a loss of income for the property. Method 6 is investing in commercial real estate. Commercial real estate distinguishes itself from single-family home investments by the level of experience required in the financing process. The different property categories under commercial real estate include office buildings, industrial properties, multifamily dwellings, mixed-use structures, retail spaces, and more. Appreciation in value and financing also differ from single-family homes. Commercial real estate's value originates from its net operating income, which can be equated to its EBITDA. This sets it apart from other property investments, such as single-family homes or duplexes, as these types of properties derive their value from comparable properties in their area, rather than the amount of income they generate. When investing in substantial multifamily units, large retail centers, or big office buildings, their value is determined by their net operating income. If you are able to improve the property and raise the lease rates, causing a significant increase in the NOI, then you can calculate the value of the building by dividing the cap rate. The real money in commercial real estate is made by maximizing the property's income through renovations, offering amenities, and boosting the income of the property. In contrast, financing for commercial real estate operates differently than for a single-family home. Typically, a maximum loan-to-value is sought. However, this can result in balloon payments which are distinct from a 15 or 30-year fixed loan available for single-family homes. Strategy number 7 on the list are triple net leases. A triple net lease is a type of commercial lease agreement where the tenant is responsible for paying all the operating costs related to the property. These costs include property taxes, insurance, and common area maintenance. This arrangement allows the landlord to be hands-off with the daily management of the property, potentially resulting in a passive income stream for them, depending on the terms of the lease. Triple net leases are often utilized in commercial real estate properties, such as retail stores and restaurants. This type of lease is appealing to landlords as it offers a consistent and steady income. A good example of a tenant that is typically under a triple net lease is Starbucks. Starbucks focuses on selling coffee, not owning and managing real estate, so the majority of Starbucks locations you see are simply renting space from the building developer or owner. Triple net leases can be a great option for those looking to invest in commercial real estate, as they provide a low-risk investment opportunity with a predictable and stable stream of income. The tenants are responsible for paying all of the operating expenses associated with the property, which can reduce the headaches of owning real estate. Additionally, triple net leases tend to have longer lease terms than other types of commercial leases. While traditional office leases can range from 3 to 5 years, triple net leases can sometimes span 15 years or more. This longer lease term is another way for landlords to ensure a smoother income flow throughout the duration of the lease. If the tenant is a reputable business like Starbucks, for instance, negotiations for renewing the lease can be initiated years in advance. If the lease is renewed, the landlord may end up with a free and clear property at the end of the lease period, and potentially make a small profit each month. Historically, cap rates for these leases tend to be around 4.5 to 5%, making them a potential source of wealth creation, especially if the property is in a prime location. In conclusion, real estate is a valuable addition to any investment portfolio. Historically, it has served as a safeguard against inflation and has consistently kept pace with it, particularly when it comes to single-family homes. Even if the real estate market isn't performing well, having some exposure to it is never a bad idea. Furthermore, the IRS highly favors real estate investments and offers numerous tax benefits and write-offs. If you want to invest in the stock market in 2023 and make sure you are not making any mistake, check this video and learn how Warren Buffett is investing for 2023 and consider subscribing to the channel.